Hello, this is Chris Schuppe with the Labasco Consulting Group. Along with me is my colleague Jim Chapman. We are with the Retirement Plan Consulting team here at Labasco, and today we're going to run through our quarterly overview of capital markets, as well as provide an update on what's going on legislatively through our legislative update. Today we're going to be covering the second quarter of 2026 and moving into the third quarter as well. A lot of interesting things going on. We're going to cover what's going on in U.S. domestic equities. We're going to cover what's going on with the economy overall, fixed income markets, as well as international markets, all important components of corporate retirement plans. With that, Jim, I want to jump in and talk a little bit about what's going on. Probably start with the S&P 500, right?
Yeah, thanks, Chris. And I think U.S. domestic equities is a great place to start just because we've had somewhat of an interesting year. The chart we're looking at is a summary of the S&P 500 going back from 1997 through June 30th of 2026. And 2026 has been an up and down year, and there's been a lot of different dynamics that are changing in the market. If you recall, during the first quarter of the year, we did see some volatility in the market. However, we've seen the market rebound in a pretty notable way. One of the interesting dynamics for 2026 has been the shift away from some of the hyperscale AI players. There's been a bit of a shift from market favoring the more growth-oriented stocks. We're starting to see value make a push. And when we look at what's driven the market in the last 2, 3, 4 years, it's really been the Magnificent Seven, the Apples, the Microsofts of the world. And that's beginning to change a little bit in 2026. And Chris, I think you're going to get into this in just a moment, but I think a lot of that's being driven by a couple key factors. And one of the first ones is just the valuations that we're seeing with some of these tech and AI focused companies paired with some of the earnings potential. We'll talk a little bit more about earnings as we're sitting in earnings season right now. We've actually seen really strong earnings reports, but some of these companies have continued to struggle from a performance perspective. And I think a lot of this, again, is just driven around valuations, a bit of a shift from focusing on, I'll say, momentum plays and getting back to some more fundamental research from a qualitative perspective. Chris, I'll let you get a little deeper. I just want to touch high level on what we're seeing right now from a broad economic and markets perspective here.
Yeah, the S&P 500 obviously is the most important measure of U.S. domestic equities, the 500 largest companies in the U.S. It's been an interesting, even if we look back over the last 4 years, we've seen incredible growth really being driven, to your point, Jim, surrounding the technology and AI, Magnificent Seven specifically. And we've seen that kind of dribble into not just those semiconductor companies or the hyperscalers, but it's actually moving into the infrastructure that's required to build out that technology as we look at utilities and power and those types of things. But on a year-to-date basis, as of this recording, we're up about 10% year-to-date with the S&P 500. Not really expecting probably what we've seen the last 3 years, where 2023 we were up 24%, 2024 we were up 23%, and then we rounded out 2025 up 18%. Certainly not sustainable numbers from a historical perspective, but we will take 10% returns all day long in the S&P 500 as it returned to more of its historical average. To your point, certainly valuations are a concern, but as we've talked about in the past, valuations don't necessarily mean there's going to be an imminent downturn in the market. Typically, it's going to be coupled with something else, a shock to earnings, to your points, or maybe an extended conflict in the Middle East could be problematic, but stocks can stay expensive for a long time and still produce strong returns. But really, you'd mentioned earnings as we get into what those valuations are, what needs to happen in order for those valuations to come to fruition. That becomes kind of the key component. If you want to jump maybe to the next slide, Jim, and we can talk about really the valuation component. The concerns are, I think, as we look at valuation measures in all 4 aspects of what we would typically look at to consider valuations, we are certainly in an elevated position. And generally, when you do have these high valuations, not to be an alarmist, and like I said, it doesn't necessarily mean that the market's going to turn, but when you look at these measures, when you have these high valuations as they are, generally that means the periods that follow, we are probably going to be expecting lower returns over the next decade if we look at these measures, specifically the CAPE index, where that's an inflation cyclically adjusted measure of price to earnings ratio. But it does provide opportunity for investment managers that are really good when we look at active managements to find some real winners in terms of the opportunities that you're looking at. Any thoughts there, Jim, in terms of the valuation aspect?
Yeah, I think valuations are always a great forward indicator of what may transpire in the market. If we look at just historical forward, each time we've seen this metric creep above 20.5 mark back during the late 90s and early 2000s during the dot-com bubble, obviously we saw a bit of a correction. Following COVID, we saw the market rally in a really strong way. We saw a correction shortly after in 2022. And then heading into 2025 and even the early part of 2026, we saw a very similar story, right? When valuations began to exceed that 20 times price to earnings mark in 2025, we saw a pullback early in the year. That a lot of that was driven around tariffs and how tariffs may impact the broader economy in the US. But more recently in 2026, we're starting to see again that shift towards maybe more, I don't want to say defensive, but more traditional stocks from a qualitative valuation standpoint. A lot of that has to do with some of the questions on how things may play out in the Middle East. Obviously, inflation has come back into the conversation, and when it comes back into the conversation, there is some concern that we may see interest rates start to rise. The Federal Reserve may take action. We did see one rate hike. And so again, when investors are thinking about where they may want to place their money, if this war in the Middle East could impact inflation through oil prices, etc., that may have an impact on interest rates. And generally, growth-oriented companies aren't favored in higher interest rate environments just because the cost of capital gets higher, and we tend to see that shift shift the focus towards value. Not to be pessimistic, but Chris, I think you hit the nail on the head on the last slide when you said that 20, 24, and 18% returns over the last 3 years are great, but frankly, probably not sustainable. 10% is something we would take all day long. Being up 10%, people are questioning if this is a down year or a slow year. Some people are being pessimistic about the market, but we would say this is a fairly normal market cycle. Maybe one thing to hit on the valuations front is just earnings per share growth and EPS growth. I don't want to spend a lot of time here, but one of the interesting factors that we're seeing play out right now is there's been a lot of anticipation for earnings calls this summer, especially for some of the larger growth and tech players. And what's interesting is a lot of these earnings calls are coming in very positively. A lot of people are beating earnings, particularly in the AI space, but we're still seeing a hesitation from investors to pay up for those higher valuations. And I do anticipate that we're going to see valuations compress a little bit. We're starting to see that already. Obviously, with the pullback, we've saw prices falling, but if earnings continue to beat and be strong, we're going to see those valuations compress, and that could be a good thing to give investors a little more confidence as we close out the year.
I think this is probably one of the most interesting slides in the deck because it really demonstrates what has occurred in the S&P 500 and how with the Magnificent Seven companies has really taken over the S&P 500. Of course, the S&P 500 is a market-weighted index, so as these companies continue to get larger, they take up more space and have much more of an impact on the S&P 500 overall. Where historically we've looked at the S&P 500 as a diversified portfolio across all industries, it's really developed because these companies now make up almost 40% of the S&P 500 overall. So it's really become almost like a concentrated technology when we look at passive indexes as far as the investment rather than being a diversified mix. But I don't know what your thoughts are, Jim, on concentration, but it's certainly wherever these Magnificent Seven companies go, and it's starting to bleed over, as I said, into other industries as far as the infrastructure, that's really where the S&P 500 goes.
Yeah, absolutely. And just to put some data to that, Chris, if you look at where we stand right now in 25 and 2026 versus where we've been historically, top 10 stocks in the S&P are making up almost 40% of the entire market, which is something we haven't seen before. And it does create some complications for investors, particularly when you have so much concentration. It does lack a little diversification in your portfolio. When these 10 stocks are doing really well, you're going to be riding really high, and it's going to be really difficult for active managers to keep pace. But on the flip side to that, and what we're seeing right now actually in 2026 is the argument for active management to have a place in large cap again. Very quickly, if you just look at the returns over the last 5-6 years here, the S&P, the Mag 7, and then the remaining stocks, over the last 5 years, the Mag 7 has dominated the market. 40%, 76, 48, 23. And active managers have had a difficult time keeping pace because, frankly, they're not going to put 40% of their portfolio into 10 stocks or 30% into 7 stocks. But as we shift our focus into 2026, I mentioned earlier, some of these tech names have been a little flat on a year-to-date basis. So Mag 7's actually at zero, status as of 6:30, but the remaining S&P's up 15%. And we're starting to see, particularly in large cap growth, active management the index for the first time in quite a while, just because they don't have such a concentration into these 7 securities. And now that we're seeing them pull back a little bit, we're seeing why diversification is always important in portfolio management. Just to put some context to this, the chart on the left-hand side of the page is showing us AI-related performance from 2023 to 2026. We're starting to see that performance pull back, particularly hyperscalers, some of our big names, those the Apples, the Googles of the world, and then on the software side of things. But to the point Chris made earlier, on the utility side, we're starting to see that infrastructure really tick up in 2026 here. Semiconductors remain strong. Hardware and the actual power behind some of this AI is still driving the market. But if you think about, again, the Mag 7 and where majority of this concentration lies, it's in these hyperscalers, a lot of the software companies, and starting to see a shift in the market to be a little more diverse into these other areas. But I'll stop for a second. Chris, anything to add on
No, I think
Mag 7?
yeah, it's just, again, it is interesting. Oftentimes what you'll see, and we saw this, of course, in 99, 2000, where there's this massive wave of technology shift, change the world type technology. And there's a tremendous amount of exuberance that pours into the major players. And I think that when we look at the Magnificent Seven, if you look at 23 and 24, really the prices of those stocks moved in lockstep with one another. When all of them were up at one time and then they would all drop at the same time, because of all this exuberance into that investment. Now we're starting to see really select the dispersion of the performance of these individual stocks are really company specific, as the market really looks closely at how these businesses are going to apply the technology, how it's going to be rolled out, what their capital expenditures are. We're seeing massive cash inflows into this technology, and how that's going to impact their business. So we have seen that. It has been interesting. But we have a long runway with AI technology and how it's going to play out, both through the economy, financial markets, and our lives in general. So it's going to be interesting to see the way that it plays out.
Yeah, absolutely. The last thing to hit on here, just some of the growth we're seeing in earnings, slight dip for the hyperscalers, but still strong. But semiconductors, hardware, even software is starting to be able to justify some of these prices.
Yeah.
All right, Chris, I may bounce around a little bit. Maybe just to hit on one point on slide 15, we've alluded to this a little bit throughout the discussion today, but for the first time in a while, we're starting to see value really come back into favor here, 16.3% versus 5.3 in large cap for growth. I want to talk a little bit to round out some discussion on the U.S. markets, on inflation, and then some projections for interest rates and how that may impact the U.S. markets, and then maybe we can shift gears into the fixed income and international. This is showing us just historical inflation. Obviously, this big spike that we see here in the center of the page, that's back in 2022 when we saw inflation really hit a historical peak. What ensued was a very aggressive interest rate increase from the Fed. And over the last year to year and a half, the Federal Reserve has been very cautious about addressing interest rates. In fact, there was a expectation that in 2025 that interest rates were going to begin to fall, and that really didn't take place. Again, the Federal Reserve had a lot of hesitation. Some of that had to do with the tariffs that were announced in early 2025 and how those may impact our broad economy and prices here at home. And then there were some economic indicators that were impacting those decisions for the latter part of 25. As we sit here in 2026, there's questions whether interest rates may continue to go up before they come down now. A lot of that's driven by this increase in inflation that we're seeing. This data is through May of 26. We saw inflation increase to around 4.2. A lot of this is driven by the oil prices that we're seeing in the Middle East. As updated data came out just a few weeks ago, we did see inflation fall, particularly core inflation. So we'll talk a little bit more about what our expectations are for inflation, but I think a lot of this, frankly, is going to depend on what transpires with this conflict with Iran, how that translates into oil prices. But something that we are keeping a close eye on is inflation. The good news is that it does seem to be flattening and actually maybe coming down a little bit here in May and June. But Chris, with that, you want to hit a little bit on just interest rate expectations?
Yeah, inflation is a big concern. We topping over 4%. The Fed's target is 2%. Kevin Warsh made it clear, he's the new chairman of the Federal Reserve recently, that the Fed's position is they have zero tolerance for out of control inflation. They're keeping a very close eye on it. We expected 2026 to be very similar to 2024 and 25, where we saw really the Fed hold a neutral position throughout the year. And then in the fourth quarter of both 24 and 25, we saw several interest rate reductions. And that's very beneficial, especially for the mid-sized, smaller-sized companies, as they're very dependent on that floating debt as far as their performance. It didn't happen necessarily. We didn't see really what we thought might happen in 2026, where we would see the year play out that way. The Fed may be in a position where they have to raise interest rates here in the near term to control this inflation, which will be a shift from what the expectations were at the beginning of the year. So they'll meet again July 27th and 28th. And it'll be interesting. This will be Kevin Warsh's second Fed meeting, and we'll make a decision on interest rates. Right now, we're sitting at 3.5 to 3.75. So we'll see what happens here at the next Fed meeting.
Thanks, Chris. And maybe just to hit a little more on interest rates, Chris talked a little bit about the impact those can have on the stock market, but let's just talk a little bit about bonds. Obviously, interest rates and bonds are very closely related. The yield curve is finally starting to normalize for the first time in, 4 years. For the last 4 years, we've been operating in this inverted yield curve environment. And in our world, it was making things a little challenging. I'm going to talk about the 401k side, thinking about things like stable value funds have historically been very competitive and attractive for plan participants. For the first time in a while, we saw money markets be the more attractive option over a stable value fund. That tune has changed, but if interest rates are to begin increasing again, that could also have an impact on the yield curve. Now, to Chris's point, we very well could see interest rates increase. I don't think they're going to increase quite as significantly and as fast as they did in 2022. Hopefully that has a less dramatic impact on our yield curve. But the other important thing to talk about when we're thinking about interest rates is how they affect bond prices. I don't know if I have the data point here today, but I believe 2022 was the worst year for the U.S. aggregate bond market in history from a pure return standpoint. And the reason being, interest rates and bond prices work inversely. When interest rates rise, the price of bonds going to fall, and vice versa. And if we think about that fundamentally, if I purchased a bond this year that has a 3% coupon rate I bought it for $100, but interest rates go up to 4% and someone can buy a 4% bond for $100, I can't sell my bond that has a 3% rate for $100 anymore because it's not worth that. Someone can go buy a 4% bond for the same price on the open market. So the value or the price of my bond is going to fall. What we're thinking about and how this may play out when we're looking at duration. So the right-hand side of the page here is showing us different types of bonds and what happens in different interest rate environments. Generally, longer duration bonds are more interest rate sensitive. Looking at some of these shorter duration or intermediate duration bonds, these are likely going to be a little more stable throughout 2026. However, obviously, longer duration bonds generally have more attractive yields and interest rates. You generally get that premium for those longer durations. And I think in fluctuating interest rate environments like we're anticipating right now, this is where really good bond managers can earn their keep. in a core fund lineup. And again, something we're going to be focusing on as a team at Lovasco is really understanding the makeup and the philosophy of the active managers we're using in the bond space, because this is an area where data does prove that active management can add a lot of value, especially in interest rate environments like we're approaching right now. Chris, anything to add on the bond front, or do you want to shift gears to international markets?
No, I think that you covered that perfectly on the fixed income front and where we're at. And we're finally being able to be rewarded for the longer duration. The hold on that becomes critically important, especially really from a strategic standpoint on the bond. If you're looking at when you're going to take income or doing any kind of liability matching, a much better framework than trying to chase yield or holding positions and then hoping that interest rates cooperate. So I think we're in a better position than we have been in the last couple of years.
Absolutely. All right, Chris, you want to lead us off here on the international front?
Yeah, global equity markets have been extremely strong the last couple of years. Talking a little bit about the value of the dollar. We've seen a weakening dollar environment, which is attractive for international companies that are headquartered outside of the U.S. as they have those earnings, and with the dollar being the reserve currency of the world, when they convert those dollars, certainly historically is proven that creates a much better environment for international markets. And we've seen that play out as we look at certainly non-U.S. markets. You can see we're up about 14% year to date. And that being driven not just with the status of the dollar, but also the valuations internationally have been very attractive, much more attractive than we've seen here in the U.S. It's much more reasonable to buy into international markets. So it's been a good place to invest. That is part of a diversified portfolio. However, as we're looking at retirement plan participants, we're still not going to overweight or fully move into international markets just because they're performing as well as they have. We still want to maintain, generally, we're going to have a position between 10 and 20% where you're going to have some international market exposure, something that's not going to be correlated to the U.S. markets, but performance has been quite strong here over the last couple of years.
As I was preparing for some reviews with clients, I was digging into some of the international data, and there's a couple things that I wanted to highlight. Very briefly, just what are some of the global equity themes that we're seeing right now? This green line, almost a vertical shot up. Asians, we talked about when we were talking about AI. This is really the emerging market space. I'm going to dive a little deeper here in just a moment, but Europe, aerospace and defense, this is starting to, I don't want to say it's not declining, but not quite on that rapid growth pace that we saw over the last few years. And then international banks continue to be a strong driver. But I want to dig into the emerging markets sector of the international market. For a very long time, active management has really thrived in the emerging market space. It's generally a sector of the market where things aren't as efficient. There's less eyes on the international market, and fundamental qualitative research can really add a lot of value. And there's still a belief around that. But given what's happened over the last few years with the surge of specifically in Asia, we're starting to see some extreme concentration in the top 10 stocks of the emerging markets benchmark. For example, Samsung and SK are making up almost 30 of the entire index, and that's just 3 companies. We have Alibaba, but the top 10 right now in emerging markets is making up 41 of the entire index. And so I talked a little bit about this earlier on. We were looking at the S&P, which is just to the left here. When markets or when these companies are performing really well, the benchmark's going to look rock solid. It's going to be really hard for an active manager to out, because frankly, no manager is going to concentrate 30+% of their portfolio into 3 stocks. They're going to have a little more diversification. They generally have guardrails internally around constructing portfolios. And right now, we're actually seeing a lot of active managers in the emerging markets sector lag the benchmark for the first time. And someone may ask the question, okay, why don't we just go back and buy the index then? Why will we pay for active management? And the reason being, if we see these 3 companies have any type of trip or slip in the market, then active management is going to offer significant downside protection. So we really haven't been in environments where we've seen this much concentration. And so there's going to be periods where active management looks attractive, and that's where we're currently sitting right now in emerging markets. That hasn't been the case historically. But over time, we do still think that specifically in the emerging market space, that active management does have a place. And just like we're seeing right now on the US side, where large cap growth managers are offering a lot of downside protection and outperforming their benchmark. If we see any type of slip in these three stocks, things are going to look dramatically different. Just wanted to highlight that emerging markets is really attractive now. These semiconductors are really driving the entire emerging markets sector, but performance is stellar at the moment. Chris, any final thoughts that we want to hit on before we wrap up?
No, and just to summarize again, although there are concerns with valuations, and obviously we have still the continued conflict in the Middle East, we're still expecting a strong year in the markets this year. Really, to summarize, S&P 500 on a year-to-date basis, we're up 10%. If we look at mid caps, we're up 15%. Small caps were up 20%. And as you noted, with international markets being up 14% and emerging markets being almost 25%, it's still been a very positive year in markets. And I'm sure participants are quite happy with what their statements look like at the end of the quarter.
Absolutely. Absolutely. Thanks, Chris. And thank you, everyone, for tuning in. Hope you found this valuable. And as always, if there's any questions or you want to dive deeper into any of the items we talked about, please reach out. We're happy to discuss.